Good afternoon, everybody. Thank you all for joining us at our webinar today, where we'll actually discuss a lot of very educational material about decoding the life insurance system here in the UK. Now, if you've tried to ever get your own life insurance in this country, you might realize that what do all these terms mean? So today, we'll hopefully, we'll walk you through the most difficult to understand jargons associated with this industry to help you make a better decision, right, on what types of protection you wish to take out. So we're just going to wait for another minute for people to join us, and then we're just going to get it kicked off. Again, at the very end, we'll open it up to the floor for any questions you may have. This is actually a very jam-packed presentation, like a webinar. So lots of different terminologies, lots of different types of things you can do. So I'm sure there will be many questions, so please bear with us. We'll get to you all at the end of the webinar. So again, Fusion Consulting Group, we are a 360-degree advisory business helping fast-growing businesses achieve their goals via tax, accountancy, financial, legal, and other services. So, and as always, as a thank you for attending this webinar, you will benefit from a complimentary financial consultation with myself or my team. And joining us today is also my colleague, Josh. He is a specialist in the insurance team. So he will, I will introduce all the types of life insurance there will be, and Josh will walk you through all the jargons and hopefully demystify and decode what they actually mean to you. Now, life insurance, right? Today, our goal is to keep it simple, right? To walk you through all these different types of insurances available, right? You might see, for example, after getting a mortgage or any types of debts, you might see a term assurance. What do all these terms mean? There's also income protection. If you don't have a good sick pay policy at work, you may wish to look at a private policy that can supplement your income in case of illness and disability, right? Because again, most people in this country are under statutory sick pay, which is just about £100 per week, which probably isn't enough for most families out there. We'll also talk about whole of life and what kind of planning can be done using these types of protection policies. Business protection, which is quite key because again, there's some good, valuable tax benefits associated with that. Also, what's increasingly more popular over recent years after post-COVID, private medical insurance. Now, let's start it off with the most common type of life insurance in the UK, which is a term assurance. Now, most people, again, when they buy their first home, when they buy their second home, the mortgage broker might actually mention, right, you should be covered for your mortgage debt, right? So if, for example, I have a mortgage of £200,000, the mortgage advisor might say, right, okay, you should put in and take out a £200,000 insurance policy in case something ever were to happen to you. Your family would essentially benefit from this covered sum to use to cover off the debt. Now, there's different types of term assurances. Now, the first, most common, most popular of all of them is the level term. So again, this is usually used to cover off debts like a mortgage, in particular, fixed liabilities, right? So we're talking about interest-only mortgages, where at the end of the term, you have that fixed capital that you need to pay back. Now, for other types of mortgages, like, for example, a repayment mortgage, which is what most people do as a resident in the main homes, then perhaps a decreasing term assurance might be more appropriate because, again, as you continue to pay down your mortgage, the debt decreases, and this type of life insurance decreases as the years go past, as your debt gets lower. And what happens is usually that these types of policies are more cost-effective initially. But you may realize that later down the line, you might be only covered for a minimum sum, let's just say £20,000, £30,000. However, your premiums are still fixed as initial. So it might actually become quite high relatively to your cover amount later down the line. Now, there's also increasing term assurance available. Now, these are covers that are indexed to inflation or based on a specific percentage. Now, again, for debts, again, there may not be a need for this because your debt doesn't actually go up, but for certain other types of, again, situations, depending on what you want to do, you may want to index it by inflation. So therefore, your cover, your benefit actually increases every single year, depending on what the inflation figures, the CPI or RPI, are at that given year. Now, the fourth type, this is a very interesting one. It's called a gift inter vivos term assurance. Now, it sounds very fancy, but it's actually very simple. It's used to cover off a potential inheritance tax exposure on gifting assets, right? So many people later in the years, they explore options about gifting assets to their children, right, to the next generation. And then they learn about that there is, a 7-year rule for inheritance tax. If something ever were to happen to you within 7 years of making that gift, you may have an inheritance tax exposure on that. Now, what is possible to do is to use a gift inter vivos policy to cover again, if the worst were to happen within those 7 years, again, that insurance policy would pay out the inheritance tax exposure of that gift, right? So essentially, it's a 7-year life insurance policy upon making a gift. The fifth type, again, very oftentimes overlooked because, again, it's not as popular as these level term assurance that pays out a big lump sum, but it's called a family income benefit. And these are usually used to cover off income requirements upon the death of the main breadwinner of the family. Now, this actually can be used in lieu of a level term or decreasing cover, right? Because, again, if something were to happen, you could either receive a lump sum to pay off the whole mortgage, right? So there's no more debts and liabilities outstanding. Or at the same time, you could actually, using this family income benefit, you get a guaranteed, let's say, £50,000, £60,000 per year, which is tax-free. And out of that income, you've actually already taken into account the mortgage payments, right? So you can use this actually in lieu of a lump sum life insurance coverage. Now, what is the benefit? It's usually lower cost because the insurance companies, right, they can pay out your benefit over time rather than giving you a big lump sum in one go. Now, lastly, critical illness. Again, this is you can usually attach this type of policy onto any of the ones above, like in the level term, decreasing, increasing. What this means is actually it's quite simple, as most of you know. It's if you get diagnosed with a critical illness, usually cancer, heart conditions, then you do have a lump sum that gets paid out to support you in the medical journey, right? Now, certain policies are can cover more diseases or less diseases, which is something that Josh will cover off later on. Now, these are higher costs, but again, in recent years, especially again post-COVID, there has been increasing probability of paying out because people are not getting the screening on time. So the risk of actually these critical illness have increased over time. And what we're seeing as well is that because there is more occurrences of critical illnesses, right, insurance companies are starting to reduce the level, so the range of critical illnesses that is covered. However, if you are taking out a policy now that covers a certain range of illnesses, then again they can't just renew on that range later down the line. So you are grandfathered into the existing scope. Now, moving on to income protection, as I said, this is essentially used to supplement any existing sick pay policies that you may have. So this is used to cover off expenditures in case of illnesses or disabilities. Now, the level of cover is usually about 50 to 70% of your gross salary. And that includes any income for business owners, that includes dividends as well. And this is because it's paid tax-free, right? So that's why it only covers about 50% to 70% of your total income. Some providers may cover less, some providers may cover up to 80%. So if you have those kind of requirements, you should speak to a specialist about it. Now, there's a lot of jargons involved with income protection, things such as, again, what kind of occupation you are, things such as deferred periods, which, again, Josh will cover off later down the line. It's very important that you get the appropriate level for your own circumstances, because everybody has different levels of sick pay at work. Some people have perhaps statutory sick pay, other people have 5 days. Sometimes big companies may offer you 6 months of sick pay, right? So, again, you can specify what kind of a level of cover you can use with these type of private policies. The next part, whole of life. Now, this is actually quite a I would say, sophisticated planning, right? Because it's used to cover off a potential inheritance tax liability. It doesn't really make sense for this to be used to cover off a mortgage because, again, there's usually a term associated with a mortgage. What whole of life means is literally, as the name suggests, it covers you, again, for the whole of your life. And because of this, it's more expensive because no matter when the inevitable death happens, this policy will pay out. It could be in 1 year, it could be in 100 years, right? So you should think of this as more like a regular savings plan. However, you never get to enjoy it. It's for the benefit of the next generation, right? Now, what's important for this type of policies is to factor in the long-term affordability, because the biggest risks for whole of life policies is what's called a lapse rate. Because lapse rate is, again, the percentage of policyholders who don't pay the premiums. Either they forget or they can't afford to over the years, right? So what that means, if you stop paying this policy, you'll usually have a 30-day grace period, but after that, the policy becomes void. So all the premiums that you've paid from before, they've been wasted. So the biggest risk of that is this, which is why the insurance companies love it, make a lot of money from people who lapse their policies, which is why, again, if you wish to take out these type of policies, it's important that you speak to a specialist and cover off your long-term affordability factor. Moving on to business protection. So for those of you who have businesses, limited companies, this is actually really, really beneficial planning because, again, as I mentioned, there are valuable tax benefits. Now, these can be broken down into 3 different types. The first one is a relevant life policy, which is actually just a death in service for small and medium-sized companies. So this is a tax-deductible life insurance for directors and employees of usually a small, medium-sized company for the benefit of their families. Again, the biggest benefit of this is company gets a tax deduction and it's not a P11D benefit. So everything is tax-free. And the actual benefit, if it gets paid out, is also tax-free to the family. The second type is called a key man. Apologies. Now, this is also a tax-deductible life insurance, but the beneficiary is actually the company itself. So now let's imagine, you have again, your company's most valuable sales person, right? So if something ever happened to them, it's a real risk to your business because, you would all of a sudden lose perhaps 20%, 30% of your revenue in the business. So what you can do is, right, use this type of policy to cover that particular person in case of their demise, right? You would get paid a lump sum so that you have time, to actually find a replacement for the person or to replace any potential loss of profits associated with the loss of that key individual within the firm. Now, the third type is actually what a lot of people don't know about, but it's actually quite important, especially for companies that have multiple shareholders. So it's called the shareholder protection. It is not tax deductible. However, right, it's important because, again, this is used to fund and structure a share purchase from the family of a deceased shareholder. If something ever were to happen, one of the shareholders, usually the big issue is, right, so those shares, as per their own will, for example, will pass on to their children or their spouses. Now, they may not be involved in the company and they may not want to be involved in the company. What this protection does is essentially the existing shareholders will get a lump sum payment, and there is a contract that's specified, there's an agreement that's specified for that money to be used to purchase the shares from the deceased family's estate, which, again, Josh will walk you through what that exactly means. It's called the cross-option agreement, and he'll walk you through what it means later on. Now, lastly, as mentioned, private medical insurance, which has gained increasing popularity post-COVID. Now, it's important, again, to check for various levels of cover. Always important to check in the fine prints for hospital coverage for what kind of, again, types of illnesses that is also covered. And yeah, this type of policy can be paid individual or by the business. However, if it's paid for by a business, it is a benefit in kind, so it will add to your tax band essentially. Now, this is the important part. This is now the fun part essentially, right? So without further ado, I'm going to introduce my colleague Josh, specialist in insurance at Fusion Financial, to bust some jargons.
Yeah, thanks, Chenji. So, essentially, these insurance policies on face value are very simple policies. You pay for something and you get something in return. Now, underneath all of that face value, there is a lot of terms and conditions built into the policies, which essentially make up the detail of the insurance policy. Now, for term assurance and whole life policies, for instance, just at the very start, there'll be two options you can choose. There's a guaranteed premium option, and there's a renewable or reviewable premium option. Now, a guaranteed premium option means that the premiums you pay for the duration of the policy will be exactly the same year on year, month on month. A reviewable or renewable option suggests that the insurance company can change these premiums depending on how your health or your age or your lifestyle changes over those years. So, for instance, if you took out a reviewable policy at the outset, it would be slightly cheaper to begin with. However, as you got older, as your lifestyle changed, as you got closer to the end of the policy, the premiums would go up. So it's very important to decide at the very beginning whether a guaranteed premium or a reviewable premium is better suited to you, because the difference can be, if you start with a guaranteed premium, you know what you're going to be paying for that policy over the next 25, 35 whole of life cover. If you choose a reviewable option, you don't know what the premium is going to be 10 years down the line when you're 10 years older, but the policy has already been in duration for 10 years. So it's very important to determine whether you want to know what your premium is going to be, or if you want to choose a lower start with a higher finish across the term of the policy. With joint life policies on term assurance, because often with a mortgage, with a cover designed for covering the mortgage, it can be a joint policy. So that means that your husband or wife or partner and partner can have a claim to the policy depending on whether the husband dies or the wife dies. Now, in that instance, the underlying condition of the policy will suggest that the policy will pay out on the first death or on the second death. Now, if it's on the first death, it means that when the first person dies, the policy pays out and the remaining beneficiary receives the money. If it's on the second death, then it's less valuable in terms of a policy option, because you will have both deceased by the time the policy pays out. And in essence, you're not taking out the policy for yourself in that case, you're taking it out for your beneficiaries or the people who will inherit the property so that they can pay it off. So it's very important to know whether you want a first death policy to pay out if the first person dies, or if you want a second death policy to pay out when you've both died and the property or whatever it is you've designed this cover for pays out. Now, waiver of premium can be built into most policy types. What it means is that if throughout the policy at any point you're taken ill and you can no longer work, you can no longer receive an income, the premiums will be paid on your behalf. So if you choose not to have a waiver of premium, and later down the line, let's say 5-10 years time, you get terminally ill, or an accident happens and you can no longer work and you can't afford the policy, the chances are you will give up that policy as one of the first things, because you need to readjust your expenditure on your reduced income. If a waiver of premium is built into the policy, what that means is that should you fall ill, the insurance company will cover the costs of the premiums because you've been paying for this waiver of premium. Now, often the amount of additional cost the waiver of premium has on these policies, it makes a lot of sense to build that into the policy. But again, it's worth speaking to a specialist to make sure that that type of cover and that term/condition is right for you. Now, most whole of life or term assurance policies, even the business policies, can be built into a trust. And it makes a lot of sense to do that, because it means when the policy pays out, it doesn't pay out direct to you or your beneficiary. It pays out into a trust, which is held outside of your estate for inheritance tax purposes. So it means that not only will the payout be exempt from inheritance tax, but you can also decide from the outset where that money goes. If there's no trust, you have to nominate a single beneficiary for the policy to pay out to. But if it's in a trust, you can build in underlying terms. You can have multiple beneficiaries to receive the payments and extra conditions in there so that the money can be used, in the same way any trust is designed, so that the money can be used in line with, your intentions. Now, as you go through the process of applying for insurance policies, there's a whole load of underwriting questions, additional screening tests from nurses and GPs reports that can rise. Now, what that means is that, up to a certain point, the insurers are happy to cover you just based on your answers to their questions. Now, if the amount of cover that you're looking for goes over a certain amount, then they will ask you for further information. They may send a nurse round to do a blood test, do some blood pressure tests, do some cholesterol tests, and just, a simple screening from a nurse. If it goes above another limit, then they may write off to your GP to request a full GP's report of your health history. Now, it's important to know that these things exist because it determines the amount of time that it will take to go from applying to the policy to being accepted and having the policy placed on risk and you being covered. So it's important to know what can arise throughout that application process so that you're aware of when to start the cover and when the cover will actually be started. Now, indexation, what does that mean? That means that if you take out a policy, it may be that you want the policy to stay the same throughout the whole term. If that's the case, it will not be an index-linked policy. There's alternatives that you can take out. One of them is being an index-linked policy. Now, what that means is that the amount that you're covered for will rise over time in line with an RPI or a CPI level of inflation to make sure that, what you took out today is still relevant tomorrow. There's a slight caveat with that, in that the indexation that they use for the policy cover, for instance, the amount they'll pay, and the indexation that they use on your premiums. So if you took out £100,000 level of cover, they would increase that with CPI or RPI. If you were paying £10 a month for that cover, that would increase with CPI or RPI times 1.5. So your premiums are going up by a higher rate than the cover is going up. And what that means is it better to have a guaranteed premium that you know what you're going to be paid out, or are you going to take a chance with interest rates being high and inflation rates being high, that the amount you pay tomorrow is an unknown quantity, and so 10, 15 years down the line, that compound inflation and indexation has risen to a point where you no longer can afford the premium on that policy. Very important to know whether it's better to take out a flat rate or an index-linked policy. Often, because of the lower start, the index-linked policies look far more attractive, but it can be a short time from now to, a short time within the policy that premium has overtaken what a guaranteed premium would have been if you were to take out a normal level of cover. Finally, there's a guaranteed insurability option. Now, usually with these insurances, the insurers underwrite you at the start, and at that point, that is the amount of cover that they have underwritten you for. Now, within some of these policy types, there's guaranteed insurability options, which means that it's already built in that you can increase the amount of cover that you have depending on your circumstances changing. So, for instance, if you get married or you move home and you need an increased level of cover, so you moved, you upsized your house and you needed a higher level of cover, there can be pre-underwritten guaranteed insurability options that the new house, the value of the new house can be covered on the same terms that the initial house was covered. So there's no additional underwriting, there's no writing off to doctors. Obviously, during the point you took out the cover initially and the point where you've maybe upgraded your house, your health or your lifestyle and your age will have all changed in that period. And so the chances are the premiums now will be more expensive than they would have been when you started the cover. This guaranteed insurability option protects you against that change of lifestyle or age or cover to pre-underwrite the future premiums. Now that was whole of life and term assurance policies. With income protection, what you're essentially doing is guaranteeing yourself an income if you're unable to work through illness, sickness, or accident. Now that seems very simple, but like Chenji mentioned, some people already have some level of sickness cover through their work. Some people are on statutory sick pay. Some people can have very good sick pay options through their employer. Now, what you can do to caveat that is choose a deferred period which best suits your circumstances. So for instance, if you had 6 months worth of full sick pay with your employer, you could choose a deferral period of 6 months, which would bring the cost right down and still apply to your circumstances. Now, if you didn't have any sickness cover at all, then the likelihood is you don't want a deferral period for 6 months, because it's going to be 6 months until you receive your first payment from the insurer, at which point your savings are likely going to be depleted because you haven't been achieving an income throughout that period. So we'll reduce the deferral period to maybe 4 weeks or 6 weeks. It will increase the premiums, but it will also increase the likelihood that there's a payout on that policy. So it's important to know whether it's worth having a longer deferral period or a shorter deferral period, and whether you can afford a shorter deferral period. And that's why it's worth speaking to a specialist to determine, based on your existing sickness cover and any savings you have, what the right level of deferral period is for you. Now, benefit periods suggest that the insurer will pay out for either a full amount of time that you're ill, or just a short-term contract for, for example, 1 year or 6 months or 2 years. Sorry, the audio left then. So just going back to the benefit period, the chances are that on a shorter benefit period, you will receive less income from the insurer than if you were on a full benefit period, i.e. to retirement age or to an age of your choice, 65, 55, whenever you choose to stop working. Now, why would you choose a short-term benefit period? Well, if you was a contractor, or if you had a short-term contract with your employer, it may be worth taking out a short-term contract. Or if your partner could support you after a certain period of time, and you've taken on that initial transition from being out of work through illness to being, adjusting to your new level of income as a family, it may be worth taking out a shorter period of benefit because the premiums will be less. However, for full level cover, you would want a longer term period of benefit so that you're continuing to receive the income over a longer period of time. Now, if you've taken out one of these policies, you may see that there's something called any occupation or own occupation. Now, what that means is that if the protection is covering you for your own occupation, what that means is that if you are ill to a point where you're no longer able to do your job, they will pay you out for the whole period of the cover. If the occupation is defined as any occupation, well, what that means is that if you are qualified to do other jobs, maybe clerical or maybe some kind of administrative job, depending, it doesn't really matter what it is, but if you're qualified to do a different job within the company, then they may pay out slightly less than they do on an own occupation, because you can get a job on a different job, but with the same company. So, for instance, if you was a company, a sales director, and you had an illness that meant you could no longer be a sales director, but you could still work to a certain point, the company could employ you on a lower position, and the insurer would, rather than pay out the full amount of benefit, they will reduce the benefit to reflect the difference between your new position and your original position. So it's important to know whether an own occupation, which covers everything, or an any occupation, which means that they may ask you to go back to work throughout the periods that they're paying, It's important to know the difference between those. Now, again, we mentioned indexation previously. It will be the same with income protection, except for the indexation will be based on the amount that they pay you as a monthly amount of cover rather than as the whole term. Now, if there are any pre-existing medical conditions, the chances are these will not be covered because they want to reduce the risk of paying out to you based on any existing cover or conditions that you have. So, for instance, if you had a high blood pressure and a condition came throughout the period of your cover that was caused by your high blood pressure, they may not cover that illness for income protection purposes.
If you like parachuting, for example, or if you like, flying for interest as a hobby, then they will actually likely say, right, we will not cover you if you get into an accident while skydiving, for example.
Exactly. If
right.
if you go deep sea diving or wreck diving, searching for treasure, then the chances are that will not be covered throughout the term of the policy because it's an extra thing which they would not be calculating into their liabilities.
And what's really important in this income protection is the benefit period, right? So, I have clients actually who have these policies have been paying out for over a decade. So for a decade of not working, they've been able to get a tax-free income, right? Essentially, but sometimes, and again, especially when you run through, some of these insurance brokerages and the online brokerages, do it yourself, you might see some very, very low rates for income protection, right? And the reason for those really low rates, upfront rates, is because they only pay for 1 year, right? So if you were to be sick, they only will pay you for 1 year or maybe 2 years. Whereas, a proper belt and braces sort of approach for income protection is that, again, they will pay for you until the policy term ends, usually until retirement, when you're able to get access to your pension funds, for example.
Exactly. And that's why it's important to discuss and understand these underlying terms and conditions within the policies so that your eyes aren't opened to the lower price policy just because it's a lower price. And often, when people choose these policies, they choose it based on price, but these underlying terms and conditions are very important to understand rather than just the headline figure. Moving on to business protection again, certain business protection policies can be written into trust. And what that does is that it protects the business so that the policy is paid out into a trust with either the business being the beneficiary. If it's a relevant life policy or a death in service policy, it can pay out to trust so that the trust pays out to the life assurance beneficiary rather than the business. And it's important to understand that you have the option of putting it into a trust rather than just the insurance company paying out to whoever is nominated as the beneficiary or the policy owner. Now, Chenji mentioned shareholder protection previously. Now, shareholder protection is a good way, like you said, to make sure that if one of the shareholders passes away, the company can purchase these shares to keep the company going. Now, it's incredible how many times there's conflict when one of the directors of a company dies and the existing shareholders are trying to purchase these shares. There's conflict due to determining the market rate of the shares. Often it's not pre-agreed. And there's also conflict in the fact that sometimes the companies don't have the funds to buy out the shareholders or the new shareholders' shares. So what the cross-option agreement does is it predetermines the price of the shares with the potential beneficiary. So, for instance, the shareholders' partner will agree with the company a set price that the shares will be worth if the shareholder is to pass away. Now, what that does is that removes any conflict when somebody passes away by predetermining the price of these shares. Now, if there's the problem where the company can't afford the shares at that point, at the point of the director dying, the shareholder protection is set up to pay out to the company for this very specific purpose of purchasing those shares from the deceased's partner or beneficiary on, a nice agreement. So, it can be that, the chances are all of the shareholders of the business have good relations with the beneficiaries and everything is amicable until such time as one of them passes away and you get caught up in trying to agree a price, trying to purchase those shares off of them, and avoiding that conflict, both for the family and the business at a time, which is going to be very sensitive, can be a very powerful thing when the time comes. What cross option agreement does is it allows to write that in an agreement, in a legal document that says this is what the shares are worth. If the shareholder dies, they have the funds to purchase those shares. PMI. So, just briefly, like Chenji said, PMI is probably the fastest growing policy type that we see. Now, the reason for that is, with COVID, there was a lot of people who needed to see doctors and couldn't, but also because of the current state of the NHS and, the future state that people perceive the NHS to be in. So they're taking out private medical insurance policies so that they don't have to deal with waiting lists and the NHS and trying to find time to speak to their doctor. They take out a private medical policy so that they can simply download an app, request an appointment with a GP, and take out a policy that will cover them for any illnesses that come up. Now, the cover is often better. The treatment that you get is often quicker, and it can make for a very solid benefit for your employees, or it can just be something that you take out on your own back because you feel like you don't want to be subject to the NHS waiting times. Now, within the PMI policies, there's a lot of different variants that are make up the policy. The first one will be the excess that you pay when a claim occurs. Now, this can range from nothing to maybe £1,500. And it's important to understand, whether this excess is payable once, whether it's payable at every claim, whether it's payable by the first person who claims or by every claimant throughout the year. So, speaking with a specialist, you can determine what level of cover is either right for your employees or right for yourself. Often, the lower the excess, the higher the premium. But if you're expecting to take out a policy, it's my view that you're expecting to use the policy. And by using the policy, you probably want the excess to be as low as possible. Now, outpatient cover. Some policies will cover outpatient cover, which is, a referral from the doctor to go to the hospital. So other policies won't. So it's important to know whether the policy that you have covers you for outpatient cover or whether it's just that initial cover that they will cover you for. We would always recommend a higher level of cover for our clients because, again, like I said, if you take out this policy, the idea is that you use it and it becomes a service in your life that you can no longer live without in the same way the NHS or doctors were previously. This is your new NHS, and so we would always recommend a good level of cover. Inpatient services. If a patient is admitted to hospital and they occupy a bed, it can be that you stay for a long period of time. If that happens, then you need to make sure that you're covered for your time spent in the hospital. Now, each policy will be different, but it's important to understand what level of cover you have if you take out one of these policies. Now, the policies can be underwritten on either a full medical underwriting basis, which will try to cover you for any pre-existing conditions, or it can be taken out on a moratorium basis, which will cover you from anything that occurs from now onwards. So if you had previous conditions or surgeries or heart problems, they wouldn't be covered on a moratorium basis, but anything that comes up outside of those previous exclusions will be covered. Full medical underwriting means that the chances are it'll be slightly more expensive, but everything that has previously been happening in your life with regards to illness or disease, all of those conditions will continue to be covered. Again, this takes me into chronic or acute conditions quite nicely. With PMI, it's usually, unless you have full medical underwriting on pre-existing conditions, it's usually only the acute conditions which arise throughout the policy term that are covered and not any previous or chronic conditions. So for instance, if you had a chronic heart condition, they wouldn't continue to cover you if you was on a moratorium basis. But with full medical underwriting, it's possible that that would be covered throughout the policy term. on an ongoing basis.
Thank you, Josh. I think, it's a very informative, but as you can see, all these different words and jargons, right? And we know this because we deal with this every single day, right? We deal with hundreds of clients. And if you were to just go out there and look at, again, on the open market, and you see very price-wise, very attractive options, but then you take into account all of these different terms and conditions, they may not actually appear to be that attractive anymore for your own circumstances. So a lot of the times what we're increasingly seeing, especially again when helping clients with existing quotes, is finding out that they have been actually in the false economy trap that these insurance companies lay out. Right? Just remember, these insurance companies, they don't care. They just know, they just have an actuary there that figures out, right, what's the most amount of premiums we can collect with the least amount of possibility of paying out, essentially. So, and actually, what we have been realizing right now is that because it is we're in a high interest rate environment, right, because insurance companies are finding it again cheaper to purchase assets that can match all these policyholder liabilities. So the premiums have actually decreased, right, and that's based on competitiveness. When one company decreases the premiums because they have cheaper outgoings, cheaper expenses, right, they try to get more customers and therefore lower the premiums. So we find out now is that there is the increasing number of more cost-effective requotes. So now is actually a really good time to get a quote or do a requote. Now, there's a few different ways to do it. The first one of all, the easiest of all, is to do it yourself. Right, there's many online platforms that allows you to do like a price comparison for these different policies. And I hope after today you get a better understanding what all these terms and what all these jargons actually mean for you, so it can help you make a more educated decision, choosing between price and appropriateness of that cover. Because again, it's only useful. The insurance is only useful if you can actually use it, right? So, and it actually covers you what you actually want it to cover. So you could also go to a broker, to a brokerage business. So that's usually, again, these type of brokers are usually attached to a mortgage business, for example, for these term assurance policies. Or, again, there's dedicated insurance brokerages who might have, again, access to more variety out there, right, in return for a small commission. And actually, perhaps, possibly, some of these brokers might even have good deals as well with specific insurance companies. So always shop around. Now, for certain types of more specialist cover, like, for example, whole of life, for example, business protection, and even actually PMI, again, because of the various levels of coverage types available, it's probably worth getting a fully advised service so that a professional can fully assess your circumstances and calculate what coverage do you actually need. And this applies because in the modern days, if you're an employee of a business, you have life insurance from work, you have sick pay from work, right? And a fully regulated and qualified advisor will help you actually understand, right, so that you're not overinsured, right, but also that you're not underinsured, right? Because what we're seeing a lot is people who do it themselves tend to either be overinsured or underinsured, i.e., didn't read through all the terms and conditions. So, yeah. And, as a thank you for attending this webinar, we're actually running a special campaign for the month of June as well, where we will be sacrificing some of these commissions from insurance companies to help our clients lower their premiums. So if you are interested, please be in touch. You contact us on the details that you can find on the left-hand side. But any questions, we're going to open up to the floor. Please don't hesitate to get in touch with us. And I hope you found this webinar very informative. So we're going to wait for another 5 minutes or so for any questions. But otherwise, a recording of this will be produced and sent to you in your email addresses that you can feel free to share to anybody that you may find helpful. So again, thank you very much for attending, and hopefully you found it helpful and insightful. Thank you. So we have a question here from Simon. Do you see clients take multiple policies out, i.e. short-term and long-term? So yeah, I think, if you would like to elaborate the question, that'd be great. So what, by multiple policies, do you mean multiple, for example, term assurance policies? I think in most instances, probably not the same type of policy, because you can have one policy that covers, again, you for the long term. But again, people explore multiple types of cover, right? For example, as we mentioned from the term assurances, some people prefer to have a lump sum pay out to cover the mortgage, and also have a family income benefit that pays out the family, right, a regular income to support their other expenses, right? A lot of times when people have young children, right, they want to make sure that they have enough, income for school fees, for example, just to, again, because, taking childcare is a full-time job. And again, if you don't want to leave behind somebody to work a full-time job and, right, to take care of the family. So we do see people take multiple types of policy, multiple policies in the same sort of type, if that makes sense. I hope this helps, Simon, but if you can elaborate as well, what do you mean by shorter term and long term? Happily to follow that up as well. Jay, question here: which RPI is used for the increase in cover? At which point does it not become worth it? Very good question, Jay. So it doesn't have to be RPI. There's usually different providers use different indices, right? So sometimes it's RPI, sometimes it's CPI. Sometimes you can even choose 1%, 2%, or 3% as a indexation option. Essentially, right, usually, again, with, because as Josh said, right, with indexation, your premiums increase at a higher rate compared to your premiums. Now, again, remember, your premiums, your benefit is usually a lot higher, right? So even though your premiums still increase at a higher rate, right, there will not nearly be as much as obviously what you might potentially get back. Now, the issue is always if you compound that 1.5x multiple over 10 years, 20 years, 30 years. So if you are taking out, if you're young right now, if you've just bought your first property, for example, and you have a 35-year mortgage, right, it probably doesn't make sense to use an indexation option, right? Or if you, again, 20 years old, you'd have an income protection policy, it may not be the best option, because again, in 30 years time, you might find yourself paying a lot more money by having that 1.5x multiplier compounded over 30 years. But if you're, for example, in your 30s, you're taking out a 10 to 20 year policy, then depending on, again, how secure you want to ensure that your benefit is inflation proof, it is probably worth it to have an indexation option associated to it. So there is no exact answer as in like which year it becomes more sort of, cost prohibitive. But if it's a policy for the very, very long term, indexation could turn out to be quite expensive. But if it's for, relatively shorter term, 10 to 20 years, then it might be a good option depending on circumstances. I hope this helps. But yeah, so any further questions, again, you have our contact details. Please feel free to follow us on all of our social media channels as well. Again, thank you to everybody who's attended. We look forward to, again, speaking to any of you, see you until the next webinar. So have a nice day ahead and enjoy the nice summer British weather. Bye-bye.
Thanks, Karen.